Hi, this is Steve Hutchinson with Hutchinson Family Offices with our monthly video. Now, normally I do this video on Monday following the labor reports that come out the previous Friday, but since we had an election, I decided to hold off until Wednesday so I could discuss more specifics as it relates to the impact of the election and our economy. Now, one of the things I don't involve myself in is sharing my opinions on these videos. Everyone's entitled to their opinions, but the facts are relevant. And we're going to discuss the facts today as we see them and how it may impact you as an investor and how you need to consider what has transpired in the last 24 hours and how it may affect you financially. We are. First, let's do a quick review of the economy. At the end of last month, we saw the GDP jump to about 2.9%. That was much, much more than expected. And that was very good. We were very pleased to see that. That means that the economy is growing, and it means that we are seeing sectors in the economy that are starting to strengthen. Now, it's far below the 3 to 4% range that we would like to see, but 2.9 is certainly heading in the right direction. It certainly, in our opinion, will stave off the chance of any type of economic recession, and we're not seeing that in the cards in the near future. Before it was on there for a little bit. I think this last report, and given what's occurred in the last 24 hours as far as the election is concerned, may push that back a little bit. Secondly, the consumer spending report in September showed that it had grown about 0.5%. That was an all-time high. So that means consumers are outspending money, and that is essential to our overall economy. Personal incomes grew at about 0.3%. That was a positive issue. So what we're seeing is we're seeing a little strengthening in the economy. We're seeing consumer spending. These are all positive trends, and that bodes well for our nation. Now, to go one step further, the financial markets. The financial markets, as we said before, we're going to be volatile as a result of the election. We're not surprised by this volatility. In fact, the night of the election, as I was watching the returns, like many of you were, I was also watching the financial markets across the country and across the world. And I saw the S&P 500 or the Dow Jones Industrial Average in the futures drop to almost 800 points. At the time of this videotape, the market's back up, maybe 150. I saw as high as up as 200. Elections do not generally have an impact on the economy or on the financial markets. They do have an impact on the economy only because of sentiment. So let's talk about what a presidency under Donald Trump may mean for you as an investor. Let's talk about some of his policies and some of the things that we expect to see under a Donald Trump administration. Well, the first thing that Donald Trump has spoke about is taxes, lowering corporate taxes. Now, how does that affect the stock markets? Well, across the board, lowering of corporate taxes puts more cash available to the companies. You, as an owner of companies, benefit from that because the profits of your company are higher. Your earnings after taxes are higher. As a result, the companies can grow, companies can redistribute that money in the form of dividends, but it's very positive for the financial markets. Lower tax rates generally bode well for the equity markets. Secondly, I think that we're going to see a simpler tax code, and I think we all welcome that, with the exception of maybe companies like H&R Block and the other tax prep companies. Most professional tax preparers, most professional tax advisors would welcome a simpler tax code. And we're hoping that Congress will push through a simpler tax code under a Trump administration. Finally, I think that we're going to see less intrusion in our life by the Internal Revenue Service. Over the last 8 years, under the present administration, the Internal Revenue Service grew at a tremendous amount. In fact, the #1 grower of jobs in the government in the last 8 years has been the Internal Revenue Service. Now, as a result of that, they have become a bigger influence in our individual lives. They've been regulating more, issuing more Rev Proc orders, different things like this. And what we want to see is that we'd like to see the Treasury or the Internal Revenue Service become less impactful in our lives. And that can be accomplished by a simplified tax code and also managing it better from the top down. I think the next step we would expect to see under a Trump administration is reduced regulations. This is extremely important, and I cannot share with you in the last 8 years how many regulations that have been put out by the various cabinet, government entities that have stifled business and even our own business. Department of Labor regulations, EPA regulations, these need to be reviewed. These regulations will be reviewed, and I believe that a lot of those are going to be eliminated. That's one of the benefits we'll see. And I think that is going to see maybe a reduction or an elimination of some of the executive orders that were pretty much the strategy of the previous administration's ability not to get something done through Congress. Well, I'll write it into law. At least it'll be there while I'm there. I think we're going to see some significant changes in the Affordable Health Care Act, or ACA. This is something that just really needs reviewing badly. We're seeing states that are having 100% premium increases. In North Carolina, we are seeing higher increases in insurance costs, and these costs are being passed on to individuals, families, and unfortunately, there's got to be a better solution. And so we look forward to getting some legislation out of the Republican-controlled House as well as the Republican-controlled Senate on the desk of a Republican president that will eliminate some of these issues. Now, I expect them to keep the good parts of the ACA. And we all know what those good parts are: not denying insurability, previous existing issues have to be managed, but I want to see a stronger, more competitive health insurance plan. For instance, in North Carolina, unfortunately, as a North Carolina company, we have one person on our one company that we can go to in the marketplace. We went outside the marketplace for our employees this year. So I'm looking for the Affordable Health Care Act to be changed. I think that will have a dramatic impact on the economy. So again, let's kind of review this. Simpler tax code, much lower rates. I'm a strong proponent of lower rates. When Ronald Reagan came into office in the 80s, we had a lower tax rate. We simplified the tax code, got it down to 3 good rates, and our economy just exploded. We had a tremendous amount of economic growth, and I would expect the same under the same situation. Repeal of executive orders that are stifling our economy, stifling our business. These are things that business owners are having to deal with, and some significant improvements in the overall Affordable Care Act. Now, what impact will that have for equities? In the stock market, it's going to have some type of impact, because clearly if you're taxing corporations less and you're getting them to be able to bring their money from overseas and reinvest it back here, and you're trying to keep things at home. You got to remember one thing about our country is that we run an $800 billion trade deficit. Now that's $800 billion of our economy that is not creating jobs here in the United States. So we've got to get that trade deficit in balance. One way to do that is to prevent companies from exporting these jobs to other countries so that we can get cheap cell phones and television sets. That's the sacrifice we make, is building a strong economic power. The outlook for interest rates, let's just go into that a little bit. I think we really didn't feel that an interest rate increase was likely in November. We did say that there was a strong possibility of one in December. I think that's back on the table. I'm not exactly sure about the dynamics between the current Federal Reserve Chairman and the President-elect. That will be watched very carefully. That needs to be addressed aggressively. So at some particular point, the Federal Reserve has to go back to what we call a normal interest rate policy, and as a result, that's going to extract some pain on the financial markets. More importantly, probably the bond market, we see the bond market very leveraged right now, and we think that may have some impact there. So overall, I'd say probably there's a better than 50% chance we'll see a rate increase in December, and probably another one in February. But a lot of that remains to be seen. And remember, the Fed has kind of positioned themselves as being data dependent. The outlook for interest rates, though, I think is going to be a little bit less predictable now that we've had an election under our belts. The outlook for the economy, we're starting to see an improving labor market, although it's not strong enough. It's not building the manufacturing sector. When I looked at the labor numbers last month, the net number of jobs that were lost in manufacturing were fairly significant. We're not seeing growth in manufacturing. We're not seeing growth in mining. We're not seeing growth in some of the labor-driven markets. We're seeing a lot of growth in government jobs and service sectors. We need to strengthen the manufacturing sector of this country. We need to strengthen those issues, and that may explain some of the success, or I believe it does explain some of the success that Donald Trump had in the Rust Belt states of Pennsylvania, Ohio, and Iowa, and going on up into Michigan and Minnesota and places like that. So I just think that that's what our economy needs right now, is some strengthening in those sectors. So we're going to be looking for that. We're going to be looking for some trade balancing policies. We're going to be looking at fair trade concepts. All of these bode well, I think, for the average investor. I think in the near term, we're going to continue to see volatility. I would not be surprised that we see at some particular point, as I've talked about in a recent video, a decline that may represent the end of a bull market. I don't think that that's out of the question. Although I do not see valuations on the companies that we follow being excessively high. We'll see how this weighs onto it. Now, as always, it's important to address these concerns directly with your advisor. Nothing can be said more than have a frank conversation. Sit down and talk to our senior portfolio manager, Todd Walker. Ask him questions about what we're doing and the companies that we're looking to put into the portfolios. Overall, I have to admit I'm very optimistic about the election. I think it's going to be a refreshing change. I think the economy is going to be ultimately have at least the tools and opportunities to be successful. Whether that manifests itself remains to be seen. I can't be a pessimist, but I have to be somewhat of a realist. So overall, I'm very impressed with what we've seen so far. We're looking for stronger economic growth as we move into the new year. We're looking for stronger employment. That'll do it for this month's video. As always, if you have any questions or any concerns, please give us a call. We'd love to hear from you, and have a great month.